Welcome back to The Explainer. Today, we're putting on our forensic accounting hats and stepping right into the shoes of a highly objective, deeply skeptical equity research analyst. We're going to look way past those flashy headlines and perform a rigorous, data-driven financial teardown of Ubiquiti, ticker symbol UI. We've got full access to their 10K, their 10Q, and a massive trove of historical financial data. So we're going to act as investigative journalists of their financial statements to figure out the true intrinsic value of this company.
Disclaimer: this is an educational case study and quantitative analysis for informational and entertainment purposes only. It does not constitute financial advice, investment recommendations, or an offer to buy or sell any securities. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. All data is sourced from publicly available filings and is subject to fair use for commentary and criticism.
Okay, let's dive right into this because we've got a really fascinating paradox on our hands. On one side of the ledger, Ubiquiti boasts a jaw-dropping 109.8% return on invested capital and literally zero debt. I mean, metrics that represent an absolute financial masterclass. But on the other side, the company is embroiled in a severe, real-world controversy. They're facing a human rights lawsuit alleging that its technology is powering Russian drone networks in Ukraine. So how on earth do we reconcile these elite financial metrics with such massive geopolitical and operational risks? What is the true intrinsic value of Ubiquiti? Well, let's find out.
Section 1. Ubiquiti's unique economic moat.
Before we run the numbers through our ultimate valuation gauntlet, we really need to understand how they actually make their money. When you look at their revenue engine, out of their $2.57 billion in fiscal 2025 revenue, enterprise technology is absolutely doing the heavy lifting. It accounts for 87.5% of the total pie. The service provider technology segment, that's just a minor slice at 12.4%. So what this tells us is that their core strength and their main growth driver lies firmly in enterprise networks, Wi-Fi, and surveillance systems. These are products that businesses are clearly just snapping up.
Now get a load of this number. A staggering 90% of outstanding shares are owned by the founder and CEO, Robert Pera. This creates what we call an extreme owner-operator moat. Think about it. His personal wealth is entirely tied to minority shareholder returns. There is absolutely no principal-agent problem here because his incentives move perfectly in lockstep with yours if you happen to hold the stock.
And that immense ownership naturally builds into an extremely lean management structure. Get this, there's no permanent chief financial officer, no chief operating officer, minimal investor relations, and Pura himself has literally taken a $1 base salary in some years. Now, this totally eliminates the bloated corporate empire building we see in so many of their tech peers, and it drives incredible capital efficiency. But look, as an objective analyst, I have to point out the really obvious corporate governance trade-off here. This lack of conventional checks and balances creates a massive key person risk. If something happens to Pera, the whole dynamic shifts.
All right, moving on to Section 2, the valuation gauntlet and Legends reality check.
So, how exactly does this highly unconventional structure translate into valuation? If we run the raw fundamentals through our ultimate gauntlet of 21 models, a skeptic's alarm bells might start ringing. In our Group A cash flow models, like the standard WACC DCF, unlevered and levered free cash flow, APV, and FCE, we're seeing really high cash conversion, but a very tight margin of safety. Looking at Group B's dividend models, your Gordon Growth, multi-stage DDM, and economic value added, they yield conservative baselines simply because of the company's tiny payout structure. Then, moving to our Group C comparables, that trailing price-to-earnings ratio of 36.84 clearly signals a pretty pricey stock. Checking Group D's asset-based models, like book value and liquidation value, we see a firm that's highly asset-light. Even when running Group E's real options valuation for future growth projects, the premium remains steep. But then, your eyes drift down to that return on invested capital, 109.8%. That is in an elite, almost unheard of stratosphere. They are generating an immense amount of cash relative to the capital they actually deploy. Add in $4.99 in net cash per share and an earnings per share of $15.55, and you're looking at a balance sheet that's basically built like a fortress.
Let's apply our Legends reality check. How would the absolute greats view this company? Over on the left, we have Ben Graham, the father of deep value investing. He would instantly reject this stock. A PE of 36.84 is just way above his strict sub-15 rule, and the current price massively exceeds his net current asset value criteria. But on the right,
Warren Buffett would likely be salivating. Buffett prioritizes quality and owner's earnings above all else. The zero debt, the immense capital efficiency, the consistent ROIC well over his 15% threshold, and the wide economic moat created by structural cost advantages. That fits his modern investment philosophy perfectly.
And adding Peter Lynch to our reality check actually brings some really interesting nuance. Lynch loves growth, right? But at a reasonable price. He definitely note that the growth is there. Quarterly revenue was up 19% year over year to $788 million. However, if you calculate his PEG ratio, price to earnings relative to growth, and factor in that tiny 0.56% dividend yield, well, it offers very little downside protection against that premium PE multiple. Lynch would likely classify this as a fast grower, for sure, but he'd remain super cautious about overpaying for it.
Section 3. Overlooked green frauds. Now let's transition to the forensic accounting portion of this explainer. The mainstream media loves a flashy headline, but as analysts, we look at the footnotes. Here are 7 overlooked green flags you need to know about. First, that 109.8% ROIC. The media ignores this because extreme capital efficiency is honestly just too complex for a quick soundbite. Second, zero debt with $368.7 million in cash. Ignored because a pristine balance sheet doesn't exactly generate clicks. Third, expanding gross margins hitting 47%. This proves they have serious pricing power, which gets ignored in favor of top-line hype. Fourth, a completely untouched $250 million revolving credit facility. That's a massive liquidity safety net flying totally under the radar. Fifth, massive institutional buying. For example, Corient just added 1.1 million shares. Unreported, mainly because combing through 13F filings is tedious. Sixth, an incredible $2.61 million in revenue per employee. Ignored because, let's face it, efficiency ratios aren't sensational news. And seventh, relentless buybacks that are constantly shrinking the float. The media ignores this because it's a slow, steady compounding mechanism rather than an overnight explosive story. Altogether, these flags prove the underlying business model is an absolute cash machine.
Let's move to Section 4, Hidden Red Flags. But hey, we wouldn't be objective analysts if we didn't flip the script, right? Let's look at the 7 deep risks we found buried in the footnotes, legal dockets, and earnings misses. These suggest some rough waters might be ahead. First up, the Dysilo-Levitt human rights lawsuit. The plaintiffs here allege that Ubiquiti Technology powers Russian drone networks in Ukraine. Impartially speaking, the financial media often misses how this specific legal action could trigger massive operational and export control sanctions against the company. Second, a Q3 earnings miss. An EPS of $3.88 versus the $4.42 estimate. Long-term bulls might ignore it, but it definitely shows near-term friction. Third, there's an ongoing IRS dispute risking $50 million. Ignored because corporate tax litigation is incredibly dense to read through. Fourth, Hong Kong tax audits that are tying up $60.3 million in deposits. Again, international tax law rarely makes the front page. Fifth, they are still missing a permanent CFO and COO. This gets ignored until a crisis hits, but it is a massive key person risk. Sixth, a $201,000 insider sale by the chief accounting officer. It seems small, but it's highly notable when executive teams are this incredibly lean. And finally, seventh, an extreme geographic revenue shift, indicating heavy reliance on international supply chains. Ignored because macro logistics are quote-unquote boring, but they represent a very severe vulnerability.
Which brings us to Section 5, Moat and Synthesis, the final verdict.
So, we've looked at the pristine financials, we've run the valuation models, and we've weighed the hidden green flags against the severe red flags. Based on the average of our 21 valuation models, spanning everything from discounted cash flows to comparable multiples, Ubiquiti screens as fairly to overvalued on a traditional basis. The PE of 36.84 absolutely makes it overvalued by Graham's strict standards. However, because of the zero debt, the $368.7 million in cash, and that phenomenal cash generation we talked about, it is appropriately priced, perhaps even fairly valued, for quality-focused investors who are willing to pay a premium for elite operational efficiency.
Now, looking at Morningstar's 5 sources of an economic moat, Ubiquiti benefits immensely from efficient scale and cost advantage. This is completely driven by their incredibly lean operational structure and an owner-operator with 90% control who flat-out refuses to build a bloated corporate empire. Assuming they can successfully navigate their tricky international supply chains and avoid major regulatory sanctions, this moat is actually likely to keep expanding over the next 3 years due to these intense structural cost advantages.
So here is your final takeaway.
The mathematical models are pointing one way, showcasing a beautiful, highly efficient cash-generating machine. But the hidden red flags, specifically the severe geopolitical, governance, and legal risks buried deep in the dockets, suggest a potential storm is brewing. Which side are you on? Do you trust the pristine balance sheet, or do the operational controversies keep you on the sidelines? As always, you have to do your own homework. Thanks for joining me on this explainer, and I will catch you on the next deep dive.